I watched my net worth get cut in half in 1982, and in that pain, I discovered the one principle that's protected my wealth through every crisis since. Let me take you back. 1982, I was on top of the world. Bridgewater was growing. I'd made some big calls that paid off. I thought I had the markets figured out. Then I made the prediction that nearly destroyed me. I was convinced Mexico's debt crisis would trigger a domino effect. Banks would collapse. Depression would follow. I went on national television, testified before Congress, told everyone the storm was coming. I was right about Mexico. They defaulted, but I was dead wrong about everything else. Instead of collapsing, the market soared. The economy roared back to life, and I sat there stunned, watching my bets implode. I lost everything. Had to borrow $4,000 from my dad just to pay the bills. Had to let go of everyone at Bridgewater except one employee. My confidence shattered. My reputation humiliated. But the worst part wasn't the money. It was the realization. I'd been playing a game I didn't understand. I thought being smart meant making bold predictions. Being right. Winning big. I was wrong. Being smart means surviving being wrong. You see, I'd been taking concentrated bets. All-in wagers on singular outcomes. I wasn't managing risk. I was gambling, and the house always wins eventually. That pain forced me to confront an uncomfortable truth. I couldn't predict the future. Nobody can, not consistently, not reliably. But here's what I could do. I could prepare for multiple futures. Most investors think they're diversified because they own a bunch of different stocks. Tech stocks, energy stocks, financial stocks, they feel safe. They're not. When the storm comes, and it always comes, all those stocks sink together. Different boats, same ocean, same hurricane. That's not diversification. That's delusion. Real diversification means owning assets that don't just look different. They behave differently. When one drowns, another floats. When one burns, another thrives. I started digging, obsessing. I studied every major crisis. The Great Depression, the 1970s stagflation, the Black Monday crash. What survived? What thrived? What protected wealth when everything else collapsed? And I found something, a pattern, a structure, a way to build a portfolio that doesn't just survive chaos. It's designed for it. I didn't find it in textbooks. I found it in wreckage. In the smoking ruins of my own arrogance. Most people won't learn this lesson. They'll keep gambling, keep thinking the next bull market will last forever, keep believing they're immune to catastrophe, until they're not. I learned it the hard way. And I'm going to show you what I discovered so you don't have to lose everything to understand it. Because here's the truth nobody wants to hear. Getting rich isn't about being right. It's about surviving being wrong. So what did I discover in that wreckage? The Holy Grail. Not some mystical secret. Not a magic formula to pick winning stocks. The Holy Grail of investing is something far more powerful and far less sexy. It's balance. Real balance. Not the fake balance your financial advisor sells you. Let me explain. Most people think they have a balanced portfolio. They've got the classic 60-40 split. 60% stocks, 40% bonds. Sounds reasonable, right? Sounds safe. It's neither. Here's what they don't tell you. That 60-40 portfolio is a lie wrapped in comfort. Stocks are roughly 3 times more volatile than bonds, which means in a 60-40 portfolio, you're not taking 60% of your risk from stocks. You're taking 90% of your risk from stocks. Think about that. You thought you were balanced. You thought 40% in bonds meant you were protected. But when stocks crash, and they will crash, your portfolio bleeds the same as everyone else's. It's a wolf in sheep's clothing. I use this analogy. Imagine a table with 4 legs. 3 legs are made of toothpicks. 1 leg is made of steel. Is that table balanced? No. It's going to collapse the moment you put weight on it. Your portfolio is the same. Most people's portfolios only have 1 real leg. Stocks. And stocks only work in one economic environment. When growth is rising. When that environment changes, the table collapses. I realized something crucial after 1982. The economy moves through 4 distinct environments. Growth rising, growth falling, inflation rising, inflation falling. 4 environments, 4 seasons, and every asset performs differently depending on which season you're in. Stocks love growth rising. They soar when the economy expands, when companies earn more, when optimism reigns. But when growth falls, stocks get crushed. Bonds, on the other hand, thrive when growth falls. When the economy contracts, interest rates drop and bonds rally. Commodities and gold, they explode when inflation rises. When the cost of everything skyrockets, hard assets protect you. Inflation-protected bonds shine when inflation is falling but still present. Stability without erosion. 4 environments, 4 asset classes, each one built for a different storm. But here's the problem. You can't predict which environment is coming next. In 1982, I thought I could. I was wrong. And it cost me everything. So I stopped trying to predict. I started preparing. Instead of betting on one future, I built a portfolio that could handle all futures. That's risk parity. Not balancing dollars. Balancing risk. Making sure each asset contributes equally to your portfolio's total risk. So when one environment hits, you don't get destroyed. You stay stable. You survive. Most investors are unconsciously making a massive bet. They're betting that the environment that worked for the last 10 years will keep working for the next 10. It won't. And when it changes, they'll panic. They'll sell at the bottom. They'll lose decades of wealth in months. I refuse to be fragile like that. Risk parity isn't about getting rich quick. It's about never being poor again. It's about building a portfolio with 4 steel legs, strong in every environment, immune to the chaos that destroys everyone else. You can't predict which storm is coming, but you can build a shelter that withstands all of them. So how do you actually build this? Let me show you the 4 boxes that control everything. Every asset you own, stocks, bonds, gold, real estate, commodities, performs differently depending on which economic box the world is sitting in. And most investors have no idea which box they're betting on. Box 1. Growth rising, inflation stable. This is the dream. The economy is expanding. Companies are earning more. Unemployment is falling. And inflation stays low enough that central banks don't panic. Stocks absolutely dominate here. Tech stocks, growth stocks. Anything tied to economic expansion soars. This was the 2010s, a decade-long party. If you owned stocks, you felt like a genius. But that's one box, one environment, one season. Box 2, growth falling, inflation stable or falling. This is recession territory. The economy contracts, companies lay off workers, profits shrink, fear spreads. Stocks get obliterated here, but bonds soar. When growth collapses, central banks cut interest rates to stimulate the economy. And when rates fall, bond prices rise. 2008 was this box. Stocks lost half their value. But long-term government bonds rallied hard. If you only owned stocks, you got destroyed. If you owned bonds too, you survived. Box 3, inflation rising, growth struggling. This is the nightmare most people forgot existed. Stagflation. Everything costs more. Gas, food, rent, but the economy isn't growing. Jobs disappear. Wages stagnate. Stocks and bonds both get crushed here. They can't handle rising inflation. It eats returns alive. But commodities, gold, they explode. The 1970s lived in this box. Stocks went nowhere for a decade. Bonds lost value to inflation. But gold went from $35 an ounce to over $800. Commodities soared. If you weren't holding hard assets, you got annihilated. Box 4. Inflation falling but still present, growth uncertain. This is the transition phase. Inflation is cooling, but it's not gone. The economy is fragile. Inflation-protected bonds do well here. Assets that give you real returns without getting destroyed by lingering price pressures. 4 boxes, 4 distinct economic environments. And here's the brutal truth. Your portfolio probably only works in one of them. If you're holding a traditional 60-40 portfolio, you're praying for box 1, growth rising, inflation low. If the world moves to box 2, you'll survive because of your bonds. But if we enter box 3, stagflation, you're finished. Stocks fall, bonds fall, your whole portfolio crumbles. and you can't predict which box is coming. I couldn't in 1982. The smartest economists in the world can't today. But you don't need to predict. You need to prepare. Most people think diversification means owning 100 different stocks. Apple, Microsoft, Tesla, Amazon. That's not diversification. That's redundancy. It's like having 100 umbrellas in a hurricane. Quantity doesn't equal protection. They all fail in the same storm. Real diversification means owning assets that zig when others zag. When stocks fall, bonds should rise. When inflation surges, commodities should protect you. When everything feels uncertain, gold should hold value. But here's the catch, and this is where most people screw it up. You can't just split your money equally across these assets because they don't carry equal risk. If you put 25% in stocks, 25% in bonds, 25% in commodities, and 25% in gold, you haven't balanced risk. Stocks are 3 times more volatile than bonds. So even with equal dollars, stocks still dominate your risk. You haven't built 4 steel legs. You've built 1 steel leg and 3 aluminum ones. The table still collapses. So how do you measure risk and how do you balance it? Balancing risk, not dollars. The math behind it, risk isn't measured in dollars. It's measured in volatility. And this is where most investors get it completely wrong. Let me break it down. Stocks swing violently. In a bad year, they can drop 30, 40, even 50%. In a good year, they might jump 20 or 30%. That's volatility. That's risk. Bonds, on the other hand, move gently. A bad year might see them drop 5%. A good year may be up 10%. Same dollar amount invested. Completely different risk. So if you put $50,000 in stocks and $50,000 in bonds, you think you're balanced 50-50. You're not. Stocks are carrying about 90% of your portfolio's risk. Bonds are barely doing anything. When the storm hits, your portfolio moves almost entirely with stocks. Your bonds are just dead weight. That's not balance. That's a false sense of security. Here's what I realized. To truly balance risk, you need to adjust your allocations based on volatility. If stocks are 3 times more volatile than bonds, you need to hold 3 times less stocks or 3 times more bonds. But wait, if you hold 3 times more bonds, you're giving up returns, right? Not if you use leverage intelligently. And here's where people panic. They hear leverage and think danger, recklessness, blowing up. But leverage isn't inherently dangerous. It depends on what you're leveraging. Let me use an analogy. Imagine you're driving 2 cars. One is a Ferrari, one is a minivan. If you drive both at the same speed, say 100 miles per hour, which one is more dangerous? The Ferrari. It's built for speed, but it's twitchy, hard to control. One wrong move and you're in the ditch. The minivan, it's stable, boring, safe. Now what if you slow the Ferrari down to 50 miles per hour and give the minivan a little gas, push it to 70? Suddenly, the minivan is faster. But it's still safer than the Ferrari at full speed. That's leverage on low-risk assets. Bonds are the minivan. They're stable, predictable, low volatility. If you use modest leverage on bonds, say 2x or 3x, you're increasing their contribution to returns without making your portfolio riskier than just holding stocks. Stocks are the Ferrari. High return potential, but wild swings. You don't leverage stocks. You reduce their weight. Slow them down. Here's a simplified example. Traditional portfolio, 60% stocks, 40% bonds. Risk contribution, stocks carry about 90% of the risk. Bonds contribute almost nothing. Risk-Parity portfolio, maybe 25% stocks, 40% leveraged bonds, say 2.5x, 20% commodities, 15% gold. Now each asset contributes roughly equally to your total portfolio risk. Stocks, 25% of risk. Bonds, 25% of risk. Commodities, 25% of risk. Gold, 25% of risk. 4 steel legs. Real balance. When growth rises, stocks carry you. When growth falls, bonds rally. When inflation surges, commodities and gold protect you. No single environment destroys you. But here's what nobody tells you. Leverage sounds terrifying until you understand the math. Leverage on a volatile asset, like stocks, is insane. You're amplifying chaos. Leverage on a stable asset, like government bonds, is manageable. You're amplifying stability. A 2x leverage bond position is still safer than an unleveraged stock position. Let that sink in. Most people are terrified of the wrong things. They avoid leverage on safe assets but happily load up on risky stocks with no leverage. That's backwards. I'm not saying go crazy. I'm not saying use 10x leverage. I'm saying use intelligent, modest leverage on low volatility assets to balance risk across environments. And if you can't stomach leverage, fine. You can still build a risk-parity approach by overweighting bonds and underweighting stocks, but you'll give up some returns. The principle remains, balance risk, not dollars. Here's the part that keeps people up at night, rebalancing. Markets shift, volatility changes. What was balanced 6 months ago might not be balanced today. You have to rebalance, quarterly, annually, whenever risk allocation drifts too far. It's boring. It's unglamorous. It requires discipline, but it's the difference between surviving and thriving. When COVID hit in March 2020, stocks tanked 35% in weeks. Panic everywhere. But bonds rallied, gold surged. A risk-parity portfolio stayed relatively stable while everyone else bled. That's the power of balance. But here's what nobody tells you about building this. The step-by-step build, practical execution. Nobody tells you that the hardest part isn't understanding this. It's actually doing it. So let me give you the exact step-by-step process I use. No theory, just execution. Step 1. Identify your 4 asset categories. You need exposure to all 4 economic environments. That means 4 core asset classes, stocks, global equities, not just U.S. stocks, diversified globally. You want exposure to economic growth wherever it happens. Bonds, long-term government bonds. These rally when growth collapses and central banks cut rates. Treasury bonds, safe haven assets. Commodities, broad commodity exposure. Energy, agriculture. Metals, these protect you when inflation surges and erodes everything else. Gold, the ultimate insurance. It thrives in chaos. When trust in currencies collapses, when inflation spirals, gold holds value. 4 asset classes. 4 environments covered. Step 2. Calculate the volatility of each asset. You need to know how much each one moves. Historically, here are rough estimates. Stocks, around 15% annual volatility. Bonds, around 5% annual volatility. Commodities, around 15% annual volatility. Gold, around 15% annual volatility. You can get more precise. Look at historical data. Use the past 10 or 20 years. Calculate standard deviation if you want to get technical. But these estimates work. Step 3. Allocate inversely to volatility. This is the key. You allocate more capital to lower volatility assets and less to higher volatility ones. If bonds have 1/3 the volatility of stocks, you allocate 3 times more capital to bonds, or you use leverage to equalize their risk contribution. A simple starting allocation might look like this. 25% stocks, global equity index, 40% bonds, long-term treasuries, possibly with 2x leverage to increase risk contribution, 20% commodities, broad commodity index or futures, 15% gold. Now each asset contributes roughly equally to your portfolio's total risk. When one environment dominates, you don't get wiped out. You stay balanced. Step 4. Rebalance regularly. Markets drift. Stocks might rally and suddenly represent 35% of your portfolio instead of 25%. You rebalance. Sell the winners. Buy the laggards. Keep the risk balanced. I rebalance quarterly. Some people do it annually. The key is discipline. When everyone else is chasing the hot asset, you're selling it. When everyone's fleeing the cold asset, you're buying it. It feels wrong. It's emotionally brutal, but it works. Now, let me address the mistakes I see people make constantly. Mistake 1. Using too much leverage. Leverage is a tool, not a weapon. If you use 5x or 10x leverage, you're gambling. You're asking to blow up. Modest leverage, 2x to 3x on safe assets like bonds is manageable. Anything beyond that, you're playing with fire. Mistake 2. Ignoring correlations. Just because you own 4 asset classes doesn't mean you're diversified. If your commodities and stocks move together, you're screwed. Make sure your assets are truly uncorrelated. They should move independently. When one zigs, the other zags. Mistake 3. Overcomplicating it. Some people try to build risk parity with 20 different asset classes, emerging market debt, rate, crypto, junk bonds. Stop. 4 core assets. That's it. Keep it simple. Complexity kills execution. Mistake 4. Failing to rebalance. This is the silent killer. You build the portfolio, then you ignore it for 3 years. Suddenly, stocks are 50% of your portfolio. Bonds are 10%. You're completely unbalanced. And when the crash comes, you're destroyed. Rebalance regularly, without emotion. Let me give you real texture. March 2020, COVID hits. Stocks collapse 35% in 3 weeks. Panic everywhere. People selling everything. But in a risk parity portfolio, bonds rallied hard. Gold surged. Commodities stayed stable. The portfolio lost maybe 5% to 10%, while the S&P 500 was down a third. By the time stocks recovered, the portfolio had already stabilized. No panic, no forced selling, no sleepless nights. That's the difference. 2022, inflation spikes, stocks and bonds both fall together. A rare, brutal year. But commodities and gold? They surged. Energy prices exploded. Gold held firm. A traditional 60-40 portfolio got crushed down 15% to 20%. A risk parity portfolio? Roughly flat, maybe slightly down, but protected. This isn't about getting rich fast. It's about staying rich through chaos. It's about sleeping at night while everyone else panics. Most people won't do this. They'll chase returns in bull markets. They'll panic in bear markets. And that's exactly why most people won't survive the next crash. But there's one more piece. The final piece, the one that matters most. The mindset shift, why this works and why you'll resist it. Here's the truth you need to hear. Risk parity works. The math works. The structure works. The protection is real. But you're going to resist it anyway. And I need you to understand why. Because if you don't confront this resistance, you'll never actually build this portfolio. You'll understand it intellectually. You'll nod your head. You'll say, that makes sense. Then you'll do nothing. Or worse, you'll start, then abandon it the moment it feels uncomfortable. So let me tell you exactly what's going to happen. You're going to build this portfolio. You'll balance your risk across stocks, bonds, commodities, and gold. Then the market will enter a raging bull run. Stocks will surge 30%, 40%, maybe more. In your portfolio, it'll go up maybe 12%, 15%. You'll watch your friends brag about their all-stock portfolios doubling. You'll see headlines about the best year in decades for equities. And you'll feel like an idiot. You'll feel like you're missing out, like you're leaving money on the table, like you're playing it too safe. That feeling, that burning, gnawing regret is the price of survival. Risk parity won't make you a hero at dinner parties. It won't give you those dopamine hits of watching your portfolio explode 50% in a year. It's designed to keep you alive, not make you famous. And that's boring. Humans hate boring. We're wired for excitement, for big wins, for the thrill of the gamble. We're not wired for discipline, balanced, long-term wealth preservation. So you'll be tempted to abandon this, to go all in on whatever's hot, to chase the returns everyone else is getting. And if you do that, you'll be right back where most investors end up, rich during the good times, broke during the bad. I've watched this play out for 40 years. People optimize for upside. They chase returns. They load up on risk when markets are soaring. Then the crash comes and they panic. They sell at the bottom. They lock in losses. They destroy decades of wealth in months. Why? Because they were fragile. They built their portfolios for one environment, the good times. And when the environment changed, they had no protection. Risk parity forces humility. It assumes you don't know the future. It assumes you can't predict which environment is coming next. It assumes the only rational strategy is to prepare for all of them. Most investors don't want humility. They want confidence. They want to believe they're smarter than the market. I believed that in 1982. I was wrong, and it cost me everything. Here's what I learned. The market doesn't care about your confidence. It doesn't care about your intelligence. It doesn't care about your predictions. It cares about your preparation. Are you prepared for growth to collapse? Are you prepared for inflation to surge? Are you prepared for the environment that's working today to stop working tomorrow? If you're not, you're gambling. You're just hoping the music doesn't stop while you're still dancing. And hope isn't a strategy. Let me give you the final uncomfortable truth. Right now, right this second, your portfolio is probably a bet. It's a bet that stocks will keep going up, that inflation will stay low, that growth will continue. Maybe you're right. Maybe that bet pays off for another 5 years, another 10, but eventually the environment will change. It always does. And when it does, will you survive? Or will you be another cautionary tale? I built Risk-Parity because I refuse to be fragile. I refuse to let my wealth depend on one environment, one prediction, one roll of the dice. I've been through crashes. I've been through inflation. I've been through chaos that destroyed fortunes. And I'm still here. Not because I was smarter. Not because I predicted the future. Because I prepared for multiple futures. That's the difference between gambling and investing. Gambling is betting everything on one outcome. Investing is preparing for all outcomes. So here's my challenge to you. Look at your portfolio right now. Today, is it balanced across economic environments? Or is it a concentrated bet on one? If the economy shifts tomorrow, if growth collapses, if inflation surges, if the world enters a box you're not prepared for, will you survive or will you panic? Will you sell at the bottom? Will you lose decades of wealth because you weren't protected? I can't answer that for you. But I can tell you this. I've survived every crisis for the last 40 years because I built a system that assumes I don't know what's coming. I don't need to know. I'm prepared for all of it. The question isn't whether this works. The question is, do you have the discipline to do it? Because most people don't. Most people will read this, understand it, then do nothing. They'll keep gambling, keep chasing, keep hoping until the crash comes. And then it's too late. I built this system because I refuse to be fragile. The question is, do you?